Let's go now to our friend Beimnet Abebe from Galaxy Trading. As always, Beimnet, welcome back to Galaxy Brains.
Thank you for having me.
Man, just continues to plow along here in this new era. Bitcoin, I mean, got some decent allegory here, just stuck here. So what was the low, like 75?
Yeah, a little 74 and change.
75 to 88. It's like the new chop solidation from last year at the moment. No clear direction as where it wants to go. Maybe it wants to go lower, but same thing with kind of markets now. We're through the 90-day pause, but I don't know. Well, what's happened since the 90-day tariff pause last week? Like, where do we find ourselves?
I mean, we had a decent recovery in stocks, the third biggest up day in the S&P's history. And since then, we have rolled back over. Today, most notably, some of the semiconductor export constraints kind of hit the tape today. And so, NVIDIA's down like 10% on the day. And that's a really popular retail name and also a large component of the NASDAQ and S&P 500. And so that's dragging things lower. And in terms of, what we heard from Powell, there was nothing that really affirmed like a crazy dovish bias.
Yeah, he spoke at the Economic Club of Chicago.
He did.
Right, today on Wednesday.
Literally like 30 minutes ago.
Yeah, April 16th, Wednesday, around 2 p.m.
And he seems very measured and pretty consistent with the message he gave us last time he spoke publicly. And that message is, we still have a two-sided mandate, right? And they have to make sure that, inflation expectations and inflation doesn't get out of hand. And the balance to that is, the unemployment picture. And so, Waller basically set out a framework to think about it, late last week. And he was basically like, if you have a really aggressive tariff scenario where effective tariff rates are 25% or something in that neighborhood, then, the Fed can potentially overlook some of the inflation concerns because unemployment will definitely tick higher in a meaningful way and growth will slow down a lot. And so then you can have the more aggressive Fed path. But if we go with the more measured approach, which is like, let's say 10% baseline reciprocal tariffs and nothing too crazy beyond that, and you get some trade deals done, then that's a scenario where the Fed can actually be like much more data-driven and much less kind of concerned about like a left tail scenario. Yeah. And so, those are kind of the two paths that we can follow. I'm more inclined to think that we are going to go down the route of much more aggressive tariffs, much more aggressive slowdown in the U.S. economy. Some of the stats about the U.S. consumer have not been good recently. Starting with I'm pretty sure 12% of all credit card balances are only 12% of payments on credit cards are minimum balance payments now. The stat about Coachella was really impressive to me. Apparently 60% of folks are on payment plans.
I know, for the tickets.
Buy
now, pay later. Correct. For like escapism.
Correct. And, people are doing that with like Grubhub and, these meal apps. Savings rate has really come down. You've seen some delinquencies, tick up in autos and in kind of lower credit type of stuff. And so, I really do think that you're at the point where the consumer is stretched, like living paycheck to paycheck type of stuff. And so when prices go up, that's effectively a tax on a ton of people. And that should only help kind of fuel this kind of downward spiral and growth and employment. And you have a Fed that like is kind of constrained by the inflation side of things a little bit. And
where are we in inflation these days? It's not a headline story. Not because it's not going bad, but because
here's the
there's
thing,
other
you just
headlines.
don't know yet because the tariffs haven't fully taken effect yet, and it hasn't really hit the hard data. And so it's really hard. This morning you had retail sales that were pretty strong for the month of March. But again, could that be because of folks front-loading consumption in fear of tariffs?
Picking up new iPhones and other technology, other imported things, whatever, right?
So it's really hard. Some of the more high-frequency data points we look at, like restaurant reservations and, kind of some shopping figures, et cetera, like they're down in April.
Really?
Like they're not good. Like restaurant bookings, I think, are off like 5%. which is like a pretty
meaningful.
big deal.
Yeah.
And a lot of the turmoil in markets happened in the last 2 weeks, right? And so, like, when people were checking their statements and stuff, like,
It didn't make him say we want to go out for a fancy dinner.
it did not, but it just like started, right?
Yeah.
What does 5% to 10% less in restaurants do to the rest of the the suppliers of the food, the waiters? How do they spend
The
their
chef,
money?
yeah.
Right? And so these things take time to really hit the hard data, and so which makes it really difficult for the Fed because they can't really act without that hard data turning. Just because sentiment is bad, like, people can feel bad and still be spending a shit ton of money, right? And so the hard data might not turn yet, and so I think the Fed's going to be a little bit behind the curve at a certain point. But in my head, consumers super weak. You'll see that show up in the data. We know that there are layoffs that are going to hit the employment data, particularly government layoffs. We've had corporate America tell you that it's really uncertain right now. They don't want to make plans because things are super uncertain. That includes hiring plans, CapEx, you name it, restructuring, all that, like bringing manufacturing to the U.S., all that stuff. Like, nobody wants to do anything. Walmart pulled their guidance.
I saw that.
Right. And so I think you're going to have more and more folks that corporations mainly that are going to be like, times are uncertain ahead, and we might as well kind of bring our kind of forecasted earnings a little bit lower. And so I think you're going to see meaningful retracement in like earnings expectations as you go through the year.
Yeah. That's a lot.
That's a lot.
Wow.
And at the same time, we haven't even touched on the big thing, which is like the dollar.
Right.
Right. And the euro is at almost 114.
Wow.
Right?
Is it really?
It's like 113.
This is over just the last couple of weeks. The dollar
last couple of weeks, massive sell-off.
Saw
in the
DXY
dollar.
was sub 100 briefly.
And so, what's happening is, there's a huge international shift away from the U.S., whether that's U.S. equities, that's tourism to the U.S. or dollars.
And treasuries.
Right? And treasuries. And so, there's a massive flight away from the dollar. And so that's really interesting because, like, take something like dollar yen, right, where interest rate differentials would suggest that, dollars should be richer versus yen, but they're not. Yen's been rallying, and that shows you that there's structural dollar selling flow in the market.
Yeah.
And that's also led to things like gold repricing significantly higher. Every day, it's a new all-time high in gold. We're talking about an asset that's returned 26% year to date.
I know. It's crazy.
It's a phenomenal, debasement hedge, dollar kind of weaker hedge, and
Central bank asset, sovereign asset.
Yeah, right? And so there's a ton of money plowing in. Today was like a record day in GLD, like call option buying. And so folks are piling in.
Yeah.
And
that portends difficulty for the dollar. And
it really strikes like a very concerning note. And, the main person that's been speaking on this and kind of a shift in kind of the monetary structure we've had for a really long time, Ray Dalio, right? And, there's a lot of things we can get into, but trust and faith in the U.S. and the government and the monetary order that's existed since Bretton Woods, right? Like, you're, potentially challenging that.
Well, that we were talking about this before. You absolutely are. It's by on purpose, right?
Yeah.
Because there's this famous concept, the Triffin dilemma, which Robert Triffin, an economist in the 60s, observed. And the dilemma postulates that the issuer of the world's global reserve currency necessarily will result in them having a trade imbalance. Because to be the global reserve, you have to export your global currency to the world. So in our case, we're exporting dollars. We are a net exporter of dollars. That's why we're a net importer of goods.
Yeah.
People are buying dollars from us with goods.
Yeah.
And when you increase the cost of buying those dollars with your goods, you directly imperil the growth and position of the global reserve currency. That's what's happening, right?
No,
we're telling people, hey, we really want to sell you these dollars in exchange for your textiles or your minerals or your electronics or your chips or whatever, but you're going to have to pay more for them. And people are like, well, I don't want to do that.
Yeah.
You're supposed to have a trade imbalance in order to maintain the dollar reserve status, which is why it's one thing to tariff if it's unfair and barriers or whatever, but to do it to rectify trade imbalance is a directly that directly threatens the dollar status.
Yes, fair enough. I think there are more things going into threatening the dollar status besides, kind of
Well,
the
I mean,
tariffs.
the uncertainty of the rollout as well is like, because
Yes.
if you buy sovereign debt, it's inherently a bet on the stability of the sovereign.
Correct.
And we look a bit unstable,
Yes.
to say the
I mean,
least.
The level of volatility in the bond market over the past 2 weeks, and the fact that the treasuries didn't really act as good protection in that period, right? One of the reasons you'd want to buy fixed income is, maybe it's a hedge you get in case risk assets sell off. So, when it doesn't start performing as well as you want in those scenarios, then it makes you think like,
Maybe I should look at gold.
Why am I long this
You're
thing?
right.
And then there's also the classical arguments of like, there's not enough term premium. Why would I go out 10 years or 30 years when I can park money in the very front end of the curve and, get similar returns?
Almost the same, yeah.
Right? Like right now, 10-year treasury is 430.
Yeah.
Overnight money is 433. Right? And so there's a lot of cuts baked into the market.
Yeah, but why would you buy the 10-year?
Right? And, relative to where the 2s, 10s, or 5s, 30s has been historically, like there's still room to run by like 100, 200 basis points in certain instances in terms of like where we can get to in terms of term premium you need. So like there's a lot of moving pieces, and this is one of the most challenging environments because the administration is hard to predict. High level, I do still believe in the kind of the ethos of what they are trying to do. Like if you hear Beimnet talk about explicitly what he's trying to do, and he's like, okay, we're running a $2 trillion deficit. We need to bring that deficit to a reasonable portion, relative to GDP. Bring it from 6% plus to 3.5%. How do you do that? $300 billion a year, maybe $400 billion a year. But ultimately, like, the debt path is unsustainable,
Right.
And it does need to be addressed. And there's no way to address it like in a peaceful way, not like fighting, but like in a way that doesn't harm a lot of
disruptive.
folks. And it has to be.
It has to be big cuts and big revenue increases, and you got to get them from somewhere, right? And you're cutting with Doge and other things.
But
and
you
they're
also
trying to
need
get
the
the revenue
revenue
from
high.
tariffs. They're trying to get it from
Revenue
tariffs
from
rather
tariffs
than taxes.
and deregulation and
and
pro-growth policies.
No, I agree. And the fact the second term non-consecutive president actually has the political he has a political mandate on this, frankly, from a lot. This is why Beimnet was highlighting, right, the small portion of Americans that actually even own stocks.
Yeah,
it's like you're asking me on CNBC about this terrible rout in stocks. A lot of our voters basically, he doesn't say it this way, but basically a lot of our voters don't even own stocks.
Yeah.
So like, this is kind of what the plan is and was.
In theory, like, there's a lot of people that would want cheaper goods. How do you get cheaper goods? Recession. Like it's super hard, but like nobody can come out and say, "Oh, I want a recession."
Right, and
like,
they don't.
Impossible.
Beimnet said there won't be. Right, they're still saying they don't want one, and there won't be one.
Yes, which is like telling me like
what are the odds now from like Goldman and others? I've seen like what are the recession odds now from the banks? I've seen
60%.
Yeah, so
like, but again, it's like what like 2 quarters of negative GDP growth. Like,
what do you think?
What does that fucking mean?
I know you've been very down on digital money, digital gold money, magic internet money in this environment. But with gold ripping like this, with multipolarism becoming a more prominent feature in the geopolitical landscape, right? Like you said, reduce exposure, even reducing travel to the United States. Doesn't it stand to reason that this is an environment where at some point you might see entities, sovereign wealth funds, nations turn to digital gold as an alternative here? Shouldn't
possible.
It? Like, isn't that what Bitcoin is built for, though?
It is. But my thing is, you need to respect what the market is telling you. The market is telling you that in the gold outperforming scenario, like gold is the trade. That's why gold is up 26% year to date, basically in a straight line.
Bitcoin's down 9-10%.
Yes. And in hyper volatility, like it's really tough to justify losing money on Bitcoin to your board of investors or anybody that has.
So it just hasn't turned the corner yet as the hedging asset.
Yes.
It's simply
if it starts performing though, I could see a lot of people chasing it. A lot of macro types.
Yeah.
But at the same time, it's like, wait, I could get similar returns to like if Bitcoin's bouncing, there's a good chance that stocks are bouncing, right? And,
I agree.
And, like there are just so many alternatives.
I'm more thinking about the fundamental trade here.
Mm-hmm.
If you're like offshore, it's one thing if you're an investor trying to protect in this environment and you're saying, look, I'm not trying to take the additional cryptocurrency market risk of Bitcoin or whatever you think there is. But if you're a non-aligned nation, you need to move assets in this new world. You can't trust dollars, or you don't want to.
And gold's tough to
gold
move
you
and
can't
stuff.
move and do. You can't
But
send
here's
shares
the
of
thing.
GLD around.
So think about this.
Like, shouldn't it like work like in that way? Although there's obviously more
should.
volatility.
Yeah, more volatility. But think about this. If you're sitting in Europe, like you're looking at Bitcoin, right? And it's pretty close to the lows. You know why? Because you're thinking about it in euro terms. And so euros, let's say, up 10% from like, a month and a half ago.
Yeah.
And so in theory, the Bitcoin price to them is 10% relatively lower.
Right.
Right. And so the people abroad that are looking at Bitcoin on a non-dollar basis, like it doesn't look.
Doesn't even look this good, is what you're saying.
It does not look that good.
It looks even worse than it does to us here.
Yes.
Interesting.
Yes. And so, like, I don't know.
It hasn't sort of found its. Yeah, that's fair. That's a fair point.
Right?
It's an interesting point.
Take a look at the Bitcoin Euro chart.
I will.
Right? It's still very close to
It'll
the
probably
lows.
be the first time I've ever looked at that chart, but
Yeah.
you're right. I will.
Right? And so, like, there's a lot of things that could take Bitcoin higher. I do think that a bounce in equity markets is the most likely thing to take equities higher, because it starts the flywheel of,
we want to do
MST
investing again.
Yes.
Yeah.
And it's also like MicroStrategy, right?
Yeah.
They're a large buyer. They've bought like $8 billion of Bitcoin this year, and their stock chart's trading well, and they do more corporate actions and are able to buy more Bitcoin. Ton of other similar companies out there in the marketplace, and so I do think that
could happen.
that could happen.
Yeah.
And you just got to keep in mind.
Real
it's
quick,
finite.
didn't it feel like the tariff sort of like tantrum? They were calling it a tariff tantrum. It was sort of like the market lingo. Got the 90-day pause. Now it's sort of like you got some deals that look like they may start to emerge with some important, generally friendly economies, but big ones. Japan, Australia, I've seen to Korea, and they seem to be really focusing in on China. And yeah, you talked about this, I think, last week. You do have the two largest economies going tit for tat against each other. It's not great for the global economy and global markets, but like, are we maybe through some of the most shocking headlines around this, and now it's sort of a U.S.-China trade war with a little bit of peripheral damage? Doesn't it sort of?
We're not through the worst of it.
You don't think
so?
so?
The data hasn't actually turned yet.
Not the economic data, but I just mean the tariff headline.
The headlines, yeah, but people will react very poorly to.
And they see the trickle down stuff that ends up happening.
When people when you get a non-farm payrolls that's negative for the first time in a really long time, right? When retail sales is it's down a ton, right? Trust me, people will panic one more time.
All right, I don't mean the lows for the market, but I sort of mean the are we through the worst? Do you think of? I know it's impossible to answer given Trump, but of the tariff headlines.
Yes, but. I would think so. I think everything's going to be a little bit more gradual, and also folks just get desensitized.
Yeah.
Right? It's like, okay, how high can tariffs go between China and the U.S. now? Like, China was it doesn't make any sense for them to go higher. Like, it's already, prohibitive.
Yeah.
Right? So, you raise them another 50%.
We're in a détente.
Does nothing.
Yeah.
Yeah. It's a challenging market, but I would agree with you that you're probably through the worst of the tariff headline ping pong.
Yeah.
I just don't think you're through the worst of the market. I think you're headed for a slowdown.
All right, Beimnet Abebe, our friend from Galaxy Trading.
Thank you for having me.